Okay, you have any questions for me before I continue?
No, sir. Like, I'm yet to go through the choices questions. I'll do them today.
Okay, fine. Okay, so I'll continue now. Okay. Okay. So we are supposed to continue from here, right? Till this floating rate note we did last time, correct?
Yeah, this is the last one. Right?
Yes, sir.
So next one is this money market yield. Okay. See, now this line you have to know. Bank certificate of deposit repo and market reference rate are typically quoted as annualized add-on rate. Now, what is add-on rate? Okay, so we have to know what is add-on rate. Add-on rate. So add-on rate is followed for certificate of deposit, repo, and market reference rate. Then US Treasury bills and commercial papers are quoted as their annualized discount from face value. So annualized discount. So annualized discount rate. Discount rate. Discount rate means from the face value. We'll see what it means.
The interest rates, right?
Yeah. No, interest discount means how much profit you are getting. I'll
Okay.
explain that now.
Okay.
From the face value for 360 days. Discount rate. US Treasury bills and commercial papers. So US Treasury bills and commercial paper. Commercial. Commercial paper. Okay. US Treasury bills and commercial paper. So now what is add-on rate? Add-on rate is also called holding period return. Holding period return or holding period yield. Yield or return, anything you may say. Holding period yield is the term we use in bond. Otherwise, generally it is holding period return. HPY, holding period yield. That means, see, for example, if I say, if I say, let's say 990, let's say 980 rupees is the present value of a treasury bill. Okay. And face value will be 1000 in, let's say, for example, in 50 days remaining for maturity. Case one. Second one is some other instrument, 980, other equity. and in 50 days it is giving me 1000. Now if I have to calculate for equity, what will I say? I got uh, 20 rupees profit in 50 days. 20 divided by 980 into 100. Okay, so initially I knew this value. I didn't know that it is going to reach to 1000 after 50 days, but it reached 1000. Now you calculate how much it is coming to. 20 by 980 into 100.
Is 2.0408%.
So this is the profit I have got. Okay, now here uh, now here uh, now when it comes to T bill, how will I say? I knew the future value 1000. Only the present value was changing here. You are getting the difference here. How will I calculate? Uh, 920 out of 1000 I'm getting. For treasury bill, I will calculate profit based on the face value. So that comes to what? 2%. So that comes to 2%. And here it is 2.2408%. This is called what? This is called discount rate. Discount rate means it is calculated based on what? Based on the face value. I have not annualized one. This is only for 50 days. I have not annualized yet. We will see those sums. But here, this is what calculated based on the present value. And in treasury bills, it is calculated based on the face value. You are getting the difference. If it is calculated based on the present value, it's a normal one. Normal means what? Holding period yield, or which is also called as add-on rate. Add-on rate means profit is calculated based on the present value, 980. Discount rate means profit is calculated based on the face value.
Future.
Is it okay?
Yes.
Okay. Now, so we'll do one example. So you have to remember. Remember means if you understand, there is nothing to remember. See here. See the product. In when it comes to T bills and commercial paper. Okay. Commercial paper are discounted from face value. Certificate of deposit. Okay. So in T bill, what happens? You know very well the future value is 100 or 1000. Only the present value will keep changing. So if the future value you know already, then we will use discount rate, because from the future value we are going to calculate. Okay. If let's say in certificate of deposit, when you are depositing money, you know the present value or you know the future value. When you take, imagine you are carrying some amount in your hand. So you know the present value, but you don't know how much returns you are going to get in future. You are getting the difference. Present value you know, right? You don't know how much money you are going to get in future. So that time add-on rate we will be using, because here we will calculate based on the present value. So if you understand this much also, you don't have to mug up anything as such here. Okay. You understood the logic or not?
Yeah, like when in add-on rate we don't know the future value, but in discount rate we know the
We calculate based on the
face
future
value.
value. We know there the future value is certain. In add-on rate, the present value is certain, because when you carry some amount to your bank to do fixed deposit, you know the present value. What you don't know is the future value.
And in here, like in a bond, we don't know the present value, right? Is it
In what? In what?
like in present value
In
in a
treasury
bond?
bond, treasury bill, we know the
Yeah,
future
yeah,
value, but the present value we don't know, because that will
yeah,
keep changing here.
yeah,
That will keep changing. But we know for sure the future value is 1000 only. Okay. So that is the difference between add-on rate and
Like
discount.
the PV of the treasury bill would depend upon the interest rate and the coupon rate, right? Is it
Yeah, yeah. So
right?
that will keep changing.
Okay.
Okay, so let me take one example here. See, so let's say there is a financial instrument whose current price, present value is 980. Okay, and future value is 1000. Let's say if I want to calculate holding period yield means what? It is also called as add-on rate. So add-on rate is what? Profit 20 based on the present value. Present value is 980. Normally, this is how our normal behavior is, right? This is what we are taught in our school life, right? Profit divided by present value. Okay. Like you are buying mango for 980 and you are selling it for 1000. Okay, this is 1000. This is 100 percentage. To convert it into percentage, how much is it coming to? 20 by 980 into 100.
It was 2.04. Yeah,
2.04.
2.04008.
08 percentage.
Yeah.
Let's say the time period is here the time period is, let's say it is 90 days. Okay, 90 days. So in 90 days, but then in the calculation, days doesn't matter. I didn't factor in days anywhere. In holding period yield, I will not factor in the days. It is just the calculation that were taught to us in our school life, that a farmer bought mango for 980, he sold it for 1000. In how many days? We are not doing any such calculation. Only he got 20 profit, that is enough for us. 20 divided by 980 into 100. Is it fine?
Yes, sir.
Yes. Okay.
Yes, sir.
Yeah. Then next one. Now I will polish this one and make it better. So next one is equivalent annualized annual yield. Equivalent annual yield, EAY. How to calculate this one? Equivalent annual yield means, now this is, imagine I am from finance background. I want this to be perfect. Perfect means what? It should have compounding. It should be for 365 days. Annualized, no? Equivalent annual yield, annual. It should be for 365 days. So how will I calculate? So just imagine, I'm drawing a timeline here, 360, 365. In 90 days, 90 days should come somewhere here, correct? So in 90 days, I have got 2.0408 percentage. So in 365 days, I should get probably 4 times more, 90, 90, 90, 90, probably 4 times more. Yes or no? Correct? 90, 180, 270, 360, and 365. More than 4 times I'm supposed to get. So I'm annualizing all this. So how to annualize 1 plus 2.0408? Okay, raised to. That means this way, I'm assuming that what if this grows in the same rate for the next 1 year? Because I want to annualize equivalent annual. So it should be 365 uh, divided by 90. Okay. The formula, if I make it like a formula, it is holding period yield raised to 365 by n minus 1. This is the formula. This is percentage. So here what is happening here? See, the answer for this is what? Over 4 I will get 365 by 90. Okay, 365 by 90 I will get over 4. So this return is growing more than 4 times, and then I will minus 1 and multiply by 100 to get the equivalent annual yield. Try, check. This is 2.0408 percentage. Okay.
8.7. 5382. 382.
8.582
Yeah.
percentage. You understood this, what I have done? This is okay? Can your mind imagine this in 90 days, 2 percentage? In
Yeah.
360 days or 365 days, more than 8 percentage you are earning. So it is called as what? Equivalent annual yield.
And annualized return,
Ha,
right?
ha, ha. And you are using for 365. That annual name itself says. And you are compounding. So this
Right.
is like full-fledged. I want compounding, I want for 365 days. Okay, but this holding period is the base. Okay, from this base only we are modifying to whatever requirement we have. So equivalent annual yield is okay now. Okay. Ojes, I think you have unmuted. Hello,
He's
Ojes.
trying to speak, but there's some.
Okay, is he speaking to me?
Yeah, he's
Ojes,
speaking.
I am not able to hear you clearly. You want to type in 8.6569 percentage. Is it 569? Just check once again. 2.0408. 1 plus 2.08, 2.0408 percentage raised to what is 3? I mean, that is, I think, because of decimal thing only. What is 365 by 90 coming? How, first of all, in
That
your
is
calci,
4.05555 and then
let
6
me
at the end.
let me do that only. Better
Yeah.
I'll do it. And okay, so I go to this link.
I tried both the ways, like directly and indirectly. I got the same thing again, like 8.5.
Yeah. So I'll first of all change it to 8 decimal. Second format 8, enter 8 decimal. Then 365 divided by 90. So 4.055. So I'll store this.
And so
Store
also
1.
we can use those bracket functions, like for sure, for doing it faster, right? Hello?
Ha. Yeah. Yeah, you can use that one as well.
Yeah.
Yeah. Yeah. Yeah.
Okay.
You can use. Yeah. Then this one 2.0408 percentage. 2.0408 percentage plus 1 equal to. So this is the number raised to. Recall 1 equal to minus 1 I will do now. And into 100, 8.538. 8.5382. So it is right only. Oh, just maybe there is decimal problem in your calci. You go for 8 decimal and do it. Okay, that will be better. Okay, he mentioned it is right. Okay, yeah, fine then. Okay. Now from here now I want to go for another one called bond equivalent yield. Bond equivalent yield. Remember in when we were doing bond accrued interest, it was a very simple way we were calculating accrued interest. There was you remember this sum I'm speaking about. This clean and flat price See, accrued interest using 30 by 360 accrued interest. Now, how did we calculate accrued interest? There is no compounding. Just proportionately, we are calculating accrued interest. Okay, just proportionately, we are calculating accrued interest. Right? Just proportionately, we are calculating accrued interest. Now, same way, this word is inspired from there only. We are going to calculate accrued interest. Accrued interest. See, this is the base I told you. So this is in 90 days. Correct. 90 days. Here. 90 days. So in 90 days, the return is in 90 days 2.0408 percentage. So I want to calculate for 365 days. Bond equivalent proportionate for annual. So how much will it be? So 365 into 2.0408 percentage divided by 90. Just calculate this.
0.08276.
How come 0.08.276 is it?
Okay, so we'll have to multiply it.
By 100, yeah.
Yeah, sorry. Yeah, 8.2765.
8.2765 percentage.
Yeah.
Okay. So you see, equivalent annual yield will always be the highest. Okay, why? Because it is using compounding. Here it is not compounded, so it is close to equivalent annual yield, but it is lower than that. But this is okay. Again, the base is what? Holding period yield. From the holding period yield, I got equivalent annual yield. Very important one. Is it fine now?
Yes.
Okay. Then next one is, so 1, 2, 3. Next one is money market yield. Okay, money market yield. Now in money market yield, how to calculate? See, in money market yield, again the base is this one only, 2.0408 percentage in 90 days. How much will it be for 360 days? In money market yield, we will calculate for 360 days. So 360 into 2.0408 percentage divided by 90. Calculate.
8.1632.
Okay, this is money market yield. So what did I do? I took the base, holding period yield as the base.
You only changed the this thing, the number of days, right?
Instead of 365, I will change it to 360. Rest
Is
all
it
are same.
less than a year? Is it like
And 360 is the norm for money market.
okay?
Okay. Like treasury bill 360. See here it is mentioned. Treasury bill 360 days. Treasury bills.
Okay.
So money market.
Okay.
Okay. So you have to remember all these characteristics. Okay. Then the next one is the last one. Bank discount yield. Bank discount yield. Bank discount yield is, now this is the only difference. Okay. Bank discount yield is, this is different completely. We will not get inspired from holding period return. So how it happens is 20 rupees profit you have got, but I will calculate it from the face value here. Okay, so 20 rupees is out of 100 into 100, out of 1000, sorry, out of 1000 into 100. So this comes to what, 2%. Then I will annualize it, but annualization also for 360 days only. So for 90 days, 2%. For 360 days, how much? So 360 into 2% divided by 90. Let's calculate.
8%.
No, how much?
8.
8%.
Yeah.
Only bank discount yield is little different. That means it's kind of two steps. One is
Yeah. It is the
calculate
least,
for
right?
face value,
The lowest.
calculate for face value, and then annualize it for 360.
Also, it is the lowest, right?
Yeah, that will be the lowest because your base value becomes very big here because you are taking the
1000.
face value. Yeah, bank
Am
discount
I
yield will be
audible
the
now?
lowest. Ah, yeah, better. Yeah, tell me, huh? Yes, Ojas. Okay. Okay, you just look at this very important one, this one, and the questions will be more, what do you say? It will be more complicated when you actually do it from the website. Okay, so when you do it, so this is only the base kind of thing. You have to be very thorough with this one, and then when you will get this question, this kind of questions in the website, it will be very difficult at that time. So again, you have to let me know at that time, then again I will teach you that how to do. Okay, questions will be in 1 or 2 line only, but it will be still very complicated one. Okay, but you will certainly for sure get this question. Is it fine till here? It is okay.
Certain equivalent annual yield and bond equivalent yield, we are taking 365 days in both. So what exactly is the difference other than the
Yes.
formula?
The difference is that equivalent annual yield is compounding and bond equivalent yield is not compounding. That is the difference. So
Okay.
here compounding, here no compounding. Then here for 360 days, here future value and 360 days. Future value and 360, sorry, 365 I wrote, 360 days. Is it okay now?
Yes, sir.
Okay. Yeah. Okay. So you have to rigorously practice this, okay? Because then only other complicated sums when you will get, you will be able to understand. And also take all this positively because all these are aptitude, aptitude sums. This will help you to think better. Okay. Even you can use it in your own investments. When you do, you will know like how to annualize, why we are annualizing, what is the difference between compounding and not compounding. All that you should know. Okay, now we'll come to the questions here. Money market yield. See, there is a 90-day T-bill priced with an annualized discount. Huh. See, it is just a 2 line question. But whatever I have done now, even if you have understood, you will not be able to do this. You will find it difficulty. Okay, let's do this now together. See, 90-day treasury bill is priced with an annualized discount. So the first step that you should do is it is annualized. Always what you should think, when you get this question, think that you want to arrive at this first information. That means holding period, because once you get holding period yield, rest all you can find out from here. So to get holding period yield, what do you want? You want present value, you want profit, you want future value. These three data, how to get? Okay, that is what you should think. The first step is what? How to get the holding period return. So to get this holding period yield, I need profit and I need, see, but this is annualized discount. I want proportional discount. Proportional means what? 90-day discount. Because in 90 days, what is the profit the investor got? That's what I want to know. So
So like
first
what
step
we
one,
did was we were doing like the sums which we did was of 90 days ka we had the discount.
yes.
Like we
So
got
we
the
annualized further. Yeah.
and now we have the annualized rate and
Annualized.
now
We
we'll
will
have to
we
find
will
it for 90 days.
yeah, let's keep it standardized one. Let's calculate it to 90 days first. Okay.
Okay.
So this will give you one proper step, and then you will know that whatever way sum comes, I have to follow this step only. Otherwise, you will get confused. So calculate the profit. Calculate the profit proportional to the exact number of days invested. Okay. Proportional to the exact number of days invested. So how many days? 30 days. So how do I calculate? Proportional. See, T bill is for what? That you should know. T bill is for 360 days. That is not given here. Okay, they are saying calculate. See, whatever they want us to calculate, we will calculate later. First, we will calculate profit, present value, and future value. Holding period yield we will calculate by default. So you should know the characteristics of T bill is what? 360 days, no? Just some time back we saw here. 360 days. Okay. So 360 days. In 360 days, it is 1.2 percentage. And also remember, annualized discount means what? It is calculated based on present value or future value. Present value or future value, discount rate. It is not add-on rate, right? So it
Present
is
value, right?
no, it is future value,
Okay,
because
yeah,
add-on rate is calculated based on uh,
present.
present value. Discount, when they say discount rate, it is calculated based on future value. Okay, see here, treasury bill are annualized discount from face value. Is it okay? Face value or future value? Okay.
Yes.
So 360 days, 1.2 percentage. I want it proportional. That means for 90 days, how much? So 90 into 1.2 percentage divided by 360. Calculate this.
Zero 0.3%.
Just go for 4-5 decimal. 0.3.
So
I think
it's
it's
0.3 only.
yeah, 0.3.
Exactly
0.06.
0.3
Yeah,
percentage. Okay.
exactly.
Okay, fine. So we got proportional 0.3. Now you draw the timeline. 0.3. See, they said 1000. Acha, they said 1000 rupees. So if it is 1000, what must have been the profit then? For, see, for 100, it is 0.3 percentage. So 100 minus 0.3, 100 minus 0.3,
99.7.
99.7. Now, actually, it is 1000, correct? They said 1000. So for 1000 in 90 days, 0.3 percentage of 1000 is what? 3 rupees, right? So it will be
Yes.
997. Is this okay?
Yes.
So now I got the future value, I got the profit, and I got the present value. Is it okay? Till here, we got it. Now I can find out whatever I want. So first I will calculate Holding period yield. Holding period yield will be what? 3 divided by 997 into 100. Is it okay? Understood this one? Profit divided by present value into 100.
Yeah.
How much is this coming to?
0.3009%.
Huh. Now we will look at the question. What are they asking now? Calculate its market price. Market price we already calculated. It is 997. This is the market value. Is it fine?
Yes.
Then next
Yes, sir.
one, annualized add-on. Add-on means what? Based on the present value. See, annualized add-on yield based on 365-day year
Yeah.
is equal to bond equivalent yield. Both are same.
So now we'll calculate it on the FB, right?
See, annualized add-on yield based on 365 days. When they say like this, it is equivalent to bond equivalent yield only. Because what happens in a bond equivalent yield? I'll calculate for 365 days based on add-on yield only. This is add-on yield based on the present year. So these two are same only. So let me calculate bond equivalent yield now. How do I calculate? In 90 days? No, not 90. Is it 90? Yeah. In 90 days, 0.3009 percentage. Okay. So in 365 days, how much will it be? 365 into 0.3009 percentage divided by 90.
1.2203. I multiplied it by 100, so divide.
Yeah,
Yeah,
percentage. Understood this one? You see the answer. 9997, 1.223. See this one. The add-on yield based on 365-day year is referred to as bond equivalent yield.
Okay.
Just you take a minute
Yes, sir.
and look at all this.
So can you zoom out of it? Yeah. So like at first we got the proportionate this thing, right? So
Yeah. Okay. Yeah.
like we got the discount percentage and then we calculated the HPY
Huh. See,
and
first
then the
is
add-on
proportional.
discount.
Calculate the profit proportional to the exact number of days.
Yeah.
Second step is calculate. Once you get, calculate holding period return.
Yeah.
Calculate holding period yield.
Okay.
Is it okay? Fine now.
Yes, sir.
Okay. Huh. The next one, you have to practice this well. Okay, again, this one very, very important. It is a very high energy consuming topic, this one, but relevant one. You cannot afford to forget, because you should also know how to calculate all these things. Otherwise also, it is good to build a good mathematical brain. You require all these calculations. Okay, now next one, go through this question now. A $1 million negotiable certificate of deposit with 120 days to maturity is quoted with an add-on yield 1.4%. Okay, based on 365 days. Normally they will give all yearly basis only. Okay, calculate the payment at maturity. Now this questions, actual questions, we will see later on. What we want to know is what proportional profit and holding period yield. Okay, so first one is calculate, step one, calculate the proportional profit. Calculate the proportionate profit. Calculate the proportional profit. Spelling is wrong.
For 365 days, it is 1.4%. So what will it be for 120 days? Yeah?
Yeah, calculate the proportional profit. Yeah, first of all, you should know whether that is, yeah, this is add-on rate. Yeah, they clearly mentioned add-on rate. So in 365 days, 1.4%. And so what is the actual number of days? So proportional means actual. Okay, proportional as in actual.
It's
Yeah, let
120.
me write here actual profit. Instead of saying proportional, calculate the proportional to the exact number of days. In other words, actual profit. Okay, actual profit. So actual profit is how much? It is only for 120 days.
120 days. Yeah.
So you calculate it, cross
It is
multiply.
0.4603%.
Yeah, 0.4603%.
Yeah.
Okay, then second step is holding period yield we want. So in 120 days, so 120 days, we got 0.4603%. That means, this is what, which rate, add-on rate or discount rate? Add-on rate. That means what was 100 present value, this must have been 100%, right? We got 0.4603,
3%.
or
Like I
5,
rounded it. No, it's 3. Like I rounded it off.
0.4603%. That means
Yeah.
the out of 100 present value is 100, because we got this profit based on 100. Whereas
Yeah.
in the previous case, we got that profit based on 100 future value, because that was the discount rate.
Right.
Because this is the add-on rate, for me, my present value will be 100. Okay, so what will be my this future value? So 100 plus this profit. So it will be 100.4603. Is it okay?
100 point. Yeah.
Yes, sir.
Okay, so now I know what is the this is 1 million. Okay, so this is 1 million. Proportionally calculate then.
So let's keep
So
it 100 only. Like it will be easier for calculations.
no, but then we have to go by this number also, no?
Okay.
Okay, this is percentage wise, it's fine to keep it 100, but see, if they ask market value and all those things, let's go by this way only. So here 12340. So it will be 1004603. This much will be the amount. Okay. So I know now present value, I know future value. What will be the profit? Profit will be 4603 profit. Now I will calculate the holding period return or yield. Profit is what? 4603 divided by
Now future value, right?
1 million. Huh?
Okay,
Yeah,
holding period.
into 100. This will be 1, 2, 3, 4. So 0.4603 percentage only. This much is okay.
Yes.
Now I will look at the question. What is the question? Calculate payment at maturity. Payment at maturity is this one done. Okay. Second one is again bond equivalent yield. Okay, fine. So I will calculate bond equivalent yield. So I know this one now. This is for how many days? This is for
120.
120 days.
120.
So 120. So in 120 days, 0.4603 percentage. For 365 days, how much? So 365 into
That
0.4603,
is 1.4007.
120.
Yeah,
1.4.
1.0008. Yeah.
Okay. So yeah, so that is fine. 1.4 percentage. This is bond equivalent yield. Okay, now you take a minute, go through this.
In this add-on this thing, so like we added the proportionate this thing amount to get to arrive at the future value, right? Uh,
Huh? What? Sorry, say it
in
again.
this like this is add-on, so we added it to arrive at the future value, right? The
Ha.
0.4603,
Correct, correct.
and
Add-on
that
means
one
this profit is based on the present value. Present value will be 100. If it was 100, we got 0.4603 profit.
so in discount we take the
Based
FV.
on the discount is based on the future value.
Okay,
Add-on is based on the present value.
okay. So can you go back to that so much? Uh,
Huh. Previous sum.
Yeah, so here we like we arrived at the present value. We knew it was 100, like the everything.
Hmm.
Okay, got done.
Okay. Hmm. Is it fine? Shall I move to the next one? You take a minute, just see again, think all this. Take a minute and put this into your head, and again, then we will continue with the third sum. Okay, shall I continue? Yeah. Okay.
Yes, sir.
Okay, we'll move to the third question now. Uh, your bank deposit for 100 days is quoted with an add-on yield of 1.5 percentage based on your 360-day year. Calculate the bond equivalent yield. So actual question we'll see later. Your bank deposit for 100 days with quoted add-on yield based on 360 day. So first step is proportionate to the actual. So step 1, calculate the actual profit. So how to calculate actual profit? See, in 360 days, in 360 days, okay, 360 days, 1.5 percentage. So what is the actual days? 100 days. For 100 days, how much?
So
100
they have
into
said for 100
1.5.
days the add-on yield is 1.5%, right?
No, no, no.
Like here
Based,
they said a bank deposit.
based on 360 days year.
Okay, okay.
Okay. Calculate this one.
5, 0.5%.
0.5 and then
No, sir, sorry, I made a mistake. Sorry. It is 0.4167%.
okay. Then step 2, whether it is add-on or uh, discount add-on. So 100 days holding period yield we will calculate. 100 days. Okay. 100 days. This is the profit. 0.4167 percentage. That means this is add-on. That means present value is 100. This will be 100.4167. Okay. Now, so that's it. We have got all this number. They have not mentioned any amount, right? Not
So
amount.
we'll assume 100, right?
100 only then. Yeah.
Anytime they
So
have.
yeah, holding period yield is equal to 0.4167 now divided by 100 into 100. So 0.4167 percentage. This is the holding period yield. Okay. Now we will come to the question. Third step is only the question. So what is the question? They are saying calculate bond equivalent yield. Okay. So we'll calculate bond equivalent yield. So this is for 100 days. 0.4167 percentage. So for 365 days, what will it be?
It is 1.5209.
Huh?
1.5209.
Okay, that's it. This is bond equivalent yield. 1.5209 we'll check. Yeah, that's it. 1.5208. That is all okay. Okay. Then Next question. Yield on a semi-annual bond basis. Okay, this is another type. Semi-annual. So this we have not done so far. Yield on a semi-annual bond basis means what? First, we will calculate when they say yield on a semi-annual bond basis. Yield on a semi-annual bond basis. Yield on a semi-annual bond basis. Okay. Yield on a semi-annual bond basis. So yield on a semi-annual bond basis, how do we calculate? See, when they say yield on a semi-annual bond basis, first you calculate equivalent annual yield. So what is the equivalent annual yield? So equivalent annual yield is what? 1 plus holding period yield raised to 365 by n minus 1. Okay, here. So 1 plus holding period yield is what? 0.4167. 0.4167 percentage raised to 365 by what is n here? 100 days. So 100 minus 1. Just calculate this one. Just 1 minute. Okay, you just calculate. I'll be back. Okay. Huh. How much is it coming to?
So it is 1.5293.
Yeah. 1.5293. Okay. Now yield on a semi-annual bond basis. First, I'm just doing this mechanically. Then I will tell you what it means. Okay. So now 1.5293 percentage. Okay. 1.5293 percentage. Do raise to 1 by 2. 1 by 2 and then minus 1. I'll tell you the reason, but just do it now. That means you're taking half like as in compounded. Okay. Yeah.
Do
Raise
we
to
have to
1 by 2
multiply it
minus
by
1.
100?
Not multiply by 100. This is
Okay.
percentage only, no? And this is
Yeah.
percentage. Here you must have multiplied by 100, right?
Yeah.
Okay.
So it is 0.2366.
0.23666.
66.
Okay. Now into 2. You do. Tell me the number.
So that is 0.4733.
No, it cannot be such a big difference.
Or like that is only 4 digits.
Yeah, it is 0.8. Okay, let me do this one. Okay, wait. 1.5293 percentage. 1.5293 percentage raised to zero point 0.5, right? Which is that 1.1 by 2 I'm writing as 0.5, then minus 1, minus 1. Did I do anything wrong? Achha, I didn't do raised to something. I think I didn't do 1.5293 percentage. 1.5293 percentage raised to okay, raised to 1.5. I'm doing something wrong.
Then I'm getting the same zero, my
Ha ha
negative
ha
zero
ha ha.
point eight
Yeah, yeah,
seven.
yeah. Yeah, that is because that is because it is 1 plus, right?
876.
So 1 plus. Okay, so let me write again. 1 plus 1.5293 percentage raised to 1 by 2 minus 1. This way I should do. Okay. So
So
here,
that is 0.007617.
1.5293 percentage. 1.5293 percentage
Plus
plus
1.
1 equal to now raised to zero point 0.5
Point 5
equal
minus
to
1.
minus 1 equal to into minus 1 equal to how much I got?
0.0076.
0.00761749.
Yeah. 487. Okay.
Okay, now this I'll multiply by 2.
Into
So
2.
multiplied
That
by
is
2.
0.01523.
Yeah, 0.01523
52349.
497. Now I'll multiply by 100 to convert it into percentage and it will give me 1.523497 percentage. Okay.
5234. Okay. Yeah.
Which
What did we
is,
do here?
huh?
Like
Yeah,
what did
yeah. This calculation you understood, right? Concepts I need to tell you. So 1.5234. Initially, what was it? Equivalent annual yield was 1.5293. Here it is 1.5234 percentage. Is it okay?
so like why did we do this calculation?
That concepts I need to explain. 1.5236 they have got 55. Okay, that is all fine. 52. Okay, now what did I do and why did I do like this? So the question was semi-annual bond basis we have to calculate. So why this is there, yield on a semi-annual. See, in US, it's very common for a treasury bond to pay interest semi-annual basis. So because there they pay interest semi-annual, they have that trend over there. We have to calculate yield accordingly. So how do we calculate? Now we calculated equivalent annual yield, which gave us 1.5 to 93 percentage. Now, when I want to convert this into yield on a semi-annual bond basis, see, in
Hello,
case if you don't understand anything, there is your tip. The tip is,
hello,
if
hello,
you see, if you see,
So
that.
Otis is
hello,
speaking.
hello.
Hello, yes, Ojas.
Sir, am I audible now?
Yes, yes, yeah. Tell me, huh?
Okay, sir.
Okay. See, one tip is equivalent annual yield. This first two digit, and this will be same only, and it will be, this yield on semi-annual base, yield on semi-annual bond basis, semi-annual yield on semi-annual bond basis, yield on semi-annual bond basis will be just slightly lower. You see this one, slightly lower than the equivalent annual yield. Okay, slightly lower than the equivalent annual yield. But I'll tell you why what we are doing. What we have done, we calculated equivalent annual yield, but they are saying no, you calculate semi basis. So semi basis, that's why I have done raised to half. You understood semi now? Why I have done this step? This step is okay.
So half
Ha,
yearly basically.
half yearly done. But rate is always quoted yearly basis. So now I'm multiplying by 2. So I have again converted into yearly, but it is without compounding yearly. This is what? Without compounding yearly. Yield on a semi-annual basis means without compounding yearly. Okay, so once I get this equivalent annual yield, make it half yearly. No, because I have
But so in
compounded and made it
semi-annual
half year.
basis,
Huh?
so in semi-annual basis, right? For the first 6 months, we'll get interest, and on that again we'll get interest. So this should be the compounded one, right?
Huh? No, no, we will not get that. See, interest will be paid to the investors. They will not get back again interest on that interest, right? So that's why
Okay.
I'm making it half. And then without compounding, I'm annualizing, because finally I want annualized rate only, but without compounding. Okay, semi-annual bond means what? Without compounding annualized. But because I have already annualized, I am, reducing that. Because I have compounded, I'm reducing that compounding, raised to 1 by 2. And then whatever I get, to annualize it, multiply by 2. Proportionately annualizing instead of compounded way. Okay. In short, the answer for yield on semi-annual bond basis will be slightly lower than equivalent annual yield. In fact, first two digit will be same only. Is it okay?
Yes. So like here first we calculated the EAY. Can you scroll like zoom out?
Huh. Hmm.
Okay. Yes.
You're able to understand? Fine, okay, clear. Okay. So what we do, I think for today we will stop now here, because I want you to like go through these sums once again, and practice this. Don't just refer the sum, practice it. Okay, write it on over your book and practice it very well, and then do this model quiz also. Try this model quiz, and then if needed, then we will recap and redo this once again. Okay, and then we will go ahead. Okay, rest all will go fast only, but this one, as I said, highly energy consuming one. You have to revisit this topic again and again once in a week. And if you are registered, immediately start solving all fixed income questions, so that this topic also you immediately solve, so that we can discuss all the wrong answers here. Fine, okay.
Okay,
Okay,
sir.
I think for today we will stop, because otherwise it will be like beyond this, it will be
Okay,
too
sir.
much for you.
Yes.
Okay, so you
Yes, sir.
please recap this very well. Okay, we'll stop
Okay,
now.
sir. Thank you, sir.
Bye.
Good.
Yes.
Bye.
Thank